Evening. Welcome to Economics 330, Global Trade and Political Economy, University of New York, Medgar Evers College. Today's Tuesday, December 3rd, 2024. And welcome to the formal lecture section of today's office hour. And as I hope you now know from this week's assessment, today's lecture will be on international debt crisis. Of course, as I'm sure you also remember, last week's lecture was on international economic development. As we learned earlier in international monetary relations, when a country is unable to pay for all its imports from its exports, it has to borrow money to make up the differences.
Yes.
These borrowings may accumulate, thereby making it difficult for a country to participate in international trade, which in turn creates social, economic, and political problems within. So if you were learning objectives for this week is to explain the cause of international debt crisis, to which I would say that the textbook cause of international debt crisis includes: one, irresponsible lending on the part of creditors; two, mismanagement on the part of debtors; and three, worldwide recession. There are often worldwide recessions that is beyond the control of smaller countries, of most countries, especially smaller countries. Case in point was during COVID, of course. Another good example was when the war in Ukraine and Russia blockaded the Black Sea ports of Ukraine, and grains, which reduced grain exports from Ukraine and Russia for that matter, and that created inflation. And therefore, many nation states were unable to finance their imports because they just became simply too expensive. So that's one of the challenges that can come as a result of global recession that has nothing to do with the internal domestic economic management of independent countries, especially the smaller ones. Mm-hmm. Economic growth, population expansion, and increased government spending drive the need for borrowing. During economic downturns, governments intensify borrowing to stimulate economic activity and provide financial support, which can, at least in the short term, exacerbate debt crisis. So let me repeat that again. During economic downturns, governments intensify borrowing to stimulate economic activity and provide financial support, which can, at least in the short term, exacerbate debt crisis. Note that this is very distinct from Keynesian economics, the Keynesian model of economics that calls for government intervention during recessions. Because the Keynesian economic theory has a requirement that governments try to build economic buffers during boom economic periods. That way, it can afford to spend when there is a recession. So this is not Keynesian economics, and a number of people who are biased on the Keynesian side of economics often get asked, well, doesn't that put countries into a debt crisis when you spend to spend yourself out of a recession? That's not quite the case. Obviously, as I said, during the Keynesian model also requires that governments build up economic buffers when the economy is doing great. But because of 2008 financial crisis, we now also know that laissez-faire attitude, or a doctrine opposing government's interference in economic affairs beyond the minimum necessary for maintenance of peace and property rights, can lead to weak regulation that can result in moral hazard for businesses. So this is also another critical point. There is obviously a tension between a laissez-faire model, which is really, markets are self-regulating, that businesses are unlikely to engage in injurious activity because that will be self-defeating. and that too much regulation can stifle innovation and stifle economic growth, therefore. Another school of thought on the other side of the continuum would say that no, regulation helps standardize goods and services and guarantees a certain level of quality, thereby bringing predictability to markets, and they hopefully also allow companies to be able to scale up. So the question then is, when does too much regulation begin, and where does too few regulations end? That is really the tension in public policy with respect to economic development. So the integration of especially financial market, at least this situation can become the vehicle for contagion of international debt crisis. What that speaks to is financial instruments are really global. And the lack of regulation, say for instance, in a financial instrument that may be sold on Wall Street, realize that people all over the world may be buying into that financial instrument. And to the extent that that financial instrument is inherently flawed in the way it is conceived, or as they say, commoditized, then it could create systemic risk in the international markets, or securitized, sorry, not commoditized, the way that financial instrument is securitized. Consider that somebody from Egypt may buy that, institutions from Egypt may buy that security instrument, as will people from all over the world. To the extent that institutions from all over the world are buying into this securitized instrument that is out of Wall Street, that because of poor regulation isn't well conceived, can create a contagion effect where what should have been a localized economic downturn on Wall Street will now affect institutions all over the world. And this is, in a nutshell, what happened with the 2008 financial crisis. So the second learning outcome for this week is describe debt restructuring. Debt restructuring is a process that involves negotiating with creditors to reduce interest rates, extend repayment terms, or cut a balance. So that's really at the core of it. You want to negotiate, in this case, nation states, want to negotiate with creditors to reduce interest rates, which of course can affect how much you're required, your payment every month or every quarter, however it is structured. Interest rate can affect that, and anybody who has a mortgage would have, or even finance the car, would quickly understand how principal and interest rate are the two factors that can influence how much you pay, your payments would be. And of course, you could also extend repayment term. So if the loan were, say, 1 billion over 15 years, and you extend it to 1 billion over 30 years, you would have effectively cut down your payment in half just by extending the length of the payment of the facility. The other way, of course, would be to cut the balance. So this would be classic debt forgiveness. So restructuring of a loan can help make debt situation more manageable through smaller payments, lower interest rates, or reducing overall debt burden. There are three major ways to restructure a debt. First, bondholders. Two, haircuts. So bondholders taking a haircut means that bondholders have to forgive a section of the loan, or forgive or reduce the interest rates they agree to that the borrower is supposed to pay to service that debt. So the second is negotiating debt payment terms. And three, debt for equity swap. A classic example that is often cited and debated of the latter is the Sri Lanka 99-year lease at Hambantota port to China due to Sri Lanka's inability to repay a debt. So debt for equity swap. What this line tries to explain is that about a decade ago, I think it was now, the Sri Lankan government had a bright idea to build a port that they thought would be a major hub for international trade, especially trade that is coming as a result of China's Belt and Road Initiative. So the Sri Lankan government went ahead and borrowed heavily from China to finance this port and other um, road and rail infrastructure projects. Turns out that the economic activity at the port was did not end up being as great as Sri Lankan government had imagined, and they became unable to service the debt. So they swapped sovereignty and management of the port with China in exchange for China forgiving the debt. So China took control of the port over a 99-year period. And in return, Sri Lanka had the debt wiped out. So this will be a classic case of example of debt for equity swap. Of note, many, if not all members of the Paris Club, a group of major creditor countries, excluding China, whose role is to find coordinated and sustainable solutions to payment difficulties experienced by debtor countries, have cited Amambato Port as an example of debt diplomacy, although this point is subject to debate. You know, I would ask you, I've always said that the best way to approach scholarship is to have dialectical thinking and look at issues from all sides. I think it's very simplistic. It can appear to be very simplistic to say that, well, China knew Sri Lanka couldn't service that debt, and he made it because he wanted to, from backdoor, take over a major infrastructure, a critical infrastructure at a critical geographic space within Sri Lanka. I don't know that we will ever know that. What we do know is that Sri Lanka had an obligation to itself to ensure that the business case for the port was sound, and that they also had an obligation to service its debt. And just like any of us, if we were to buy a car and not finance a car and not make payments, the repo guy is going to show up. And that's just what happened to Sri Lanka. I don't know that it is possible for any one person to really understand what China's calculus was, or for that matter, the miscalculation, the motivation for the miscalculation for the Sri Lankan government. So the third outcome is to describe the role of the World Bank and IMF in attempting to resolve various debt crises. So as I have explained in previous classes, the World Bank's stated objective is to end poverty. And it does this by financing, sometimes through grants, projects in member states that can lead to expanded economic activity. It also helps countries develop an economic development framework, and I will advise on that economic development framework so that the country has a sense of a strategy on how to proceed. The IMF, obviously, the main role is to maintain stable exchange rate regimes so that international trade can flourish. And it does this in a number of ways. One of the classic ways, of course, is to extend capital to countries who are unable to finance their imports. Of course, to ensure that those countries who it extends credit facilities to are able to service the debt. That way, IMF can, in the future, extend more distant liquidity to other countries. IMF imposes what is known as conditionalities. And this can be fairly controversial, but I think we've also covered all sides of that issue in previous classes. The fourth learning outcome is to describe different international political economy perspectives on the debt crisis. International political economy, or the relationship between politics and economics and between states and markets in world affairs, offer three distinct theories on debt crisis. The first is a liberal theory. International institutions will intervene. 2 is economic nationalist, mercantilist, which says that states will leverage economic advantages, including debt, to advance national interest. That's what some would argue China did with the Sri Lankan port. Again, as I say, it's probably an unknown unknowable. The third is a Marxist perspective, which looks at the world as client-patron relationship between the North and the South, between center and periphery countries, and that these relationships are inherently unequal. So this concludes Module 13 lecture for this week. Our 14 will focus on the current trend in IPE. And this is really where we begin to wind down. I believe this is the second to the last class. And after that, we get to the finals, and where I know all of you guys are going to hit a home run. So with that, I'm going to end the formal lecture session and take questions.